Mastering money. 10 habits of successful investors. Being a successful investor often sounds simple, but that doesn't mean it's easy. Still, investing is the best way to build wealth over your lifetime and ensure that you're able to live the life you want to live. So it can make sense to learn from the best investors to supercharge your investing gains and avoid some of the mistakes that can derail your portfolio. So before we get started, make sure to hit that like button and subscribe to my channel. 1. Start with saving. It may sound boring, but before you start investing, you'll need to start saving. Consistently spending less than you earn means you'll actually have money around to invest. You can even make saving automatic, so you won't have to think about it each month. If you contribute to your employer's retirement plan, such as through a 401 or 403 plan, you are already participating in an automatic saving plan. These retirement plans are a great way to start investing because you can make contributions directly out of your paycheck and may even get an employer match, which is essentially free money. 2. Develop a plan. One of the best things you can do to keep you on track to meet your financial goals is to develop an overall plan. You'll want to think through your short-term and long-term goals and then invest based on those goals. It may be helpful to work with a financial advisor who can help you with identifying goals, understanding your risk tolerance, and developing an overall strategy. Once you have a roadmap in place, it can make the investing journey easier to navigate. 3. Have a long-term mindset. Investors today face a barrage of market news and commentary, most of which is focused on what's going to happen in the next day or week. It's easy to see why the average holding period for U.S. stocks was just 10 months in 2022, down from about 5 years in the 1970s, according to an analysis by broker eToro. With this increase in short-term thinking, it's actually an advantage to do the opposite. Think long-term. Having a long-term mindset means that you understand there will be ups and downs in your portfolio, and that you don't react emotionally when periods of volatility occur. Long-term investors understand that stocks represent ownership interests in actual businesses whose value will rise or fall over time based on the company's performance. 4. Treat downturns as opportunities. One way to think long-term is to mentally prepare yourself for the inevitable downturns so that you treat them as opportunities when they arrive. Bear markets are a normal part of investing, but when they happen, they can be unnerving for investors. The economic news is typically bad, and you may have plenty of reasons to think it's a good time to sell. But downturns are often when the greatest opportunities for long-term gains arise. Studies have shown that investors who invest during market downturns are significantly better off over the long term than investors who sell or just maintain their current holdings. As legendary investor Warren Buffett is fond of saying, "Be fearful when others are greedy, and be greedy when others are fearful." 5. Diversify your portfolio. Diversification is a safety factor that is essential because we should be humble enough to admit we can be wrong, according to Sir John Templeton, a legendary global investor. Most investors will want to hold a diversified portfolio to protect themselves from the risk of having all their eggs in one basket. Being diversified means holding a broad selection of stocks across industries and market capitalizations. You'll also want to think about how to diversify across different types of assets, such as stocks, bonds, cash, and alternative investments, such as real estate. 6. Pay attention to costs. All investors should pay attention to the various costs associated with their investments. These costs may come in the form of account fees at certain brokers or fund fees for owning ETFs or mutual funds. These costs may seem small, often expressed as a percentage of your investment, but just a 1% annual fee can have a major impact on your investments over a multi-decade time frame. Investing in low-cost index funds is one way to help your portfolio costs stay low. These funds typically charge less than 0.10% annually, ensuring that more of the return goes to you instead of the fund manager. If you're working with a financial advisor, be sure you understand their fee structure and the costs associated with the investments they put you in. 7. Consider taxes. Investors sometimes forget about the tax impacts of certain investments, but it's something important to keep in mind. You will owe taxes on any capital gains or income realized in taxable accounts, such as a brokerage account, However, tax-advantaged accounts allow you to defer or eliminate taxes altogether. Retirement accounts, such as IRAs and 401k, allow your contributions to be invested and grow tax-free until you start making withdrawals during retirement. This means that you can realize investment gains and receive dividend or interest income along the way without having to worry about paying taxes. 8. Invest in what they understand. They adhere to the principle of investing in only what they understand. They recognize that thorough comprehension of an investment's underlying mechanisms, risks, and potential rewards is essential for informed decision-making. By avoiding complex financial instruments or industries they lack familiarity with, intelligent investors minimize the risk of making uninformed choices driven by speculation rather than sound analysis. It helps their investments align with their knowledge base and allows them to make strategic, well-reasoned decisions that contribute to their long-term financial success. 9. Stick with your plan, even when markets look unfriendly. When the value of your portfolio falls, it's only human to want to run for shelter. But the best investors don't. Instead, they maintain an allocation to stocks they can live with in good markets and bad. The financial crisis of late 2008 and early 2009 might have seemed a good time to run for safety and cash. But a Fidelity study of 1.5 million workplace savers found that those who stayed invested in the stock market during that time were far better off than those who headed for the sidelines won. In the decade following the crisis, those who stayed invested saw their account balances, which reflected the impact of their investment choices and contributions, grow 147%. That's twice the average 74% return for those who fled stocks during the fourth quarter of 2008 or first quarter of 2009. While most investors did not make any changes during the market downturn, those who did made a fateful decision with a lasting impact. 10. Be a saver, not a spender. While it's easy to get caught up in the ups and downs of the market, it's also important to think about how much of your income you are putting away for the future. Saving early and often can be a powerful force when it comes to making progress toward long-term financial goals. As a general rule, Fidelity suggests putting away at least 15% of your income for retirement, including any employer matched to, of course. That number is just a starting point. For some people it will be lower, and for some people it will be higher. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to my channel for more content. Hit the notification bell to stay updated with my latest videos. Share your thoughts in the comments below. Thank you for watching.